Hello there. This is Keith Singer of Singer Wealth. I wanted to talk about something that I heard Dave Ramsey say recently. He was pretty adamant that the correct withdrawal rate from your stock portfolio without having to really worry about running out of money was 8% per year. Meaning, if you have $1 million nest egg and you have it invested in the stock market and you are, let's say, 65 years old and you want to take income but never run out of money, but also increase that income for inflation, he suggests that you could take 8% per year or $80,000 a year and then take a little bit more each year going up with inflation. The reason that he believes that, or at least the reason that he states that, is because if you go back since 1926, the S&P 500 has averaged just under 12%, I think 11.8%. But here's what Dave Ramsey isn't considering. Number one, that the stock market hasn't averaged 11.8% in every 10 or 15 or 20-year period. It's averaged that over 97 years, and nobody who enters retirement has a 97-year time horizon before they need to start taking money out of their account. And so there have been decades and 15-year periods where the stock market's been negative. So you can do the math. If you happen to get a negative stock market for a decade and you're taking 8% a year out, you're going to be out of money pretty quickly. In fact, if you had invested all of your money in the S&P 500 index in the year 2000 and said, all right, I'm retiring now, and you had a crystal ball, you would realize that the S&P 500 would average 7.4% between 2000 and 2022. So if you knew that the S&P 500 was only going to average 7.4%, you certainly couldn't take out 8% a year going up inflation. In fact, what happens if you took out 5% a year going up with inflation? Well, the reality is you would have been out of money in 16 years, taking 5% a year out of the S&P 500. That's assuming that you paid no management fees, no expense charges, no trading costs, no taxes, and all of your money was invested in the S&P 500. Now, does that sound realistic? Does any of those things sound realistic? Of course not. There are going to be taxes. There are going to be expenses. There are going to be time periods where you don't make 12% a year or 15% a year. There's going to be time periods where you lose money. And therefore, it is not smart to tell people to take out 8% a year and don't worry about running out of money, because the odds are that you have a very high likelihood of running out of money if you pull out 8% a year. However, if you can add alternative investments to your portfolio, like private credit, which is yielding 10%, and private mortgages, which are yielding over 10%, and structured income notes, which can be yielding 8 to 10%, and private preferred stock, which can be yielding 8%, all of a sudden, now you can take out a lot more because you have the income coming out without touching your principal, and you're better diversified. So even if we do get a bad stock market, you won't have nearly the same kind of downward movement in your account value as you would had you had all your money invested in stocks. So if you want to learn about alternatives and actually legitimately find a way to increase the amount of money you could take from your portfolio each year without the same risk that you would have if you took a lot of money from your stock portfolio, definitely click for more information. Hit us up at Singer Wealth. Looking forward to helping you make smart choices about your money.